Today on One, we have with us Mr. Kalpen Parekh, President at DSP Mutual Fund, to discuss everything about investing abroad. Watch this video till the end to understand all the aspects of investing outside India, and do not forget to subscribe to our channel. So, let's go. Hello everyone, I am CA Rohit Gyanchandani and I welcome you all to this special edition of the sessions that we do, that is one-on-one with the fund managers. And today we have Mr. Kalpen Parekh, President of DSP Mutual Fund, with us to discuss on the international investing or overseas investing for Indian investors. Thank you so much, Kalpen sir, for doing this with us.
Thanks, Rohit. Thank you for inviting me.
So international investing in India has picked up quite nicely in the recent past. There has been a lot of new fund launches, both in the active as well as passive categories. So what is your take on investing outside India?
My take, Rohit, always is that anything which has picked up recently is something you should study deeply and analyze calmly and not just get carried away because it is a trend which has picked up. Most often, the right time to invest in most things is when it is not picked up. So, and international investing is no different than any investing. It's just that you are capturing the profitability of global companies versus profitability of Indian companies. End of the day, it is as similar as equity investing that we do in India as well. It's no different. It will have the same volatility and ups and downs like Indian markets. It will also have its periods of glory like last 5-7 years when global indices have done far superior to India. At the same time, it will have its own phases, long phases of pain. So I want to start by highlighting that international investing is no different than any investing. Please understand the nuances and the risks and the rewards, and then take the next step in this journey.
Absolutely. It is when a lot of people say that there is, negative correlation and all those things. The bottom line here is that essentially both of them are equity linked, whether it is Indian equities or US equities. So even if there is a, negative correlation, or they are not completely correlated or uncorrelated.
It is actually no correlation. It's lesser correlated, but it's never negative correlation. So, over the last 10, 20, 50 years, if equity as an asset class has done well, generally equity in good markets and good companies have done well, and vice versa. So I would say that it's relatively less correlated, but clearly the trends are always, the directions are more or less similar.
Yes, I was just reading in some book where it said that one should just pick the date on the date that he was born. So let's say your date of birth, and then pick today's date and check how the market was at that time and today. And if it has gone up, then it is going to go up, and it is just an indicator of economy, and essentially it is a leading indicator. So if the market is going up, essentially the economy will follow and all those things. And if you believe that the country will grow, then the markets will grow too.
See, my take, Rohit, is we tend to simplify or oversimplify some of these things, and there is no certainty that if markets have gone up, economy will go up or vice versa, because there always are leads and lags, and there are different drivers at play at different points in time. So, last 10 years, markets have gone up much faster than the economy, and so it doesn't necessarily mean the economy has earned the right to go up just because prices have gone up. Prices can go up for right reasons. Prices can go up for wrong reasons. Doesn't necessarily mean that takeaway always is linear. And then there are a lot of deeper nuances which, hopefully as you invite more and more speakers who can, educate. I always say that in investing, there are two sides of the coin. There are phases of good returns and there are phases of bad returns. As long as we are aware of that and not looking only at one side of the coin, then we will take the right decisions and we will become better investors. So always look for a real coin which has two sides. Most often in investing, we get attracted to the glamour part of the coin, to that side of the coin which suits our opinion, our portfolios. So if I have a larger weight to equity, my opinion would be that market should always go up, and vice versa. So there are a lot of these nuances. I don't want to oversimplify at this point, and we'll see how it progresses.
Right. So, Indian stock market itself has generated decent returns in long term for investors. So, why do you think that there is a need to diversify, across geographies by doing international investing?
Yeah, I think the reason for that is, if you look at our daily uses of products and services, and if we actually budget our expenses, we have already diversified so much. Today, the conference that we are doing is a Cisco product. The instrument that we are using is an Apple product. The medium through which we connected was Twitter. So, in the real world, everything is reasonably connected. And, we have truly become a global world because of these networks which have happened, right? Number one. Number two, as an investor, we should never take such sides that India बहुत अच्छा है या India बहुत अच्छा नहीं है, the rest of the world is too good. These opinions will change, Rohit. Today there is a certain opinion, tomorrow there will be a certain opinion. You ask people in the 1980s and 90s when our markets used to go nowhere for long periods of time. There were scams in those days, for example. And then the period of 2003 to 2008, emerging markets in India could do nothing wrong. Markets went up. I hope we get a similar phase sometime in our future careers, because that type of a move has not happened now in the last 13 years, where Nifty itself went up 700% in 4 years. So obviously the question that time is very valid, that यहाँ पे इतना return बनता है, तो why go elsewhere? But with the same thought, if one had not thought of fundamental diversification in a portfolio, if you look at 2008 to 2021, 13 years have passed. In these 13 years, a simple S&P 500 has generated superior returns to Nifty at a very fundamental level. So now, as an investor, our time horizon ideally should be decadal, but more often they are 3 years, 5 years, 7 years. And there will be different sub-trends. And having access to good companies around the world, which includes India also, nothing wrong in that. How does it matter to me if I make similar or better returns from a company outside India or company inside India? So all I'm trying to say is that be agnostic to the country, be agnostic to the geography, prefer a framework of why. And now my next point is that, see, a lot of ultimately in investing, when you look at equity as an asset class, what are the few variables that matter? The ROE of the asset class. Is the ROE meaningfully different than fixed income? So if interest rates in India are, let's say, 5%, inflation is another 3 to 4%, 9%. Is equity as an asset class, wherever I invest, whether in India or outside, does it have the return on equity superior to this combination of real rates of return? If the answer is yes, you should invest in equity. Then the second question is, how much are you paying for that ROE? So if for two companies, the ROEs are same, the growth rates are same, but valuations are different, you will ideally buy the one with cheaper valuation. Or for two companies, if valuations are similar, but someone else has a better ROE, reinvestment rate, better growth profile. So today, thanks to a completely globalized world and thanks to digitization and technology, a lot of companies which are emerging in different parts of the world are catering to world markets, not to only one country. So the profitability or the profit pool is much larger. Now, today is a different story. I'll come to that later on. But 5 years back, a lot of these companies were growing at probably 1.5 to 2 times of the profit pool of India. Not have leverage, but they were leveraging on technology and the network effect. And they were growing fast. They had superior ROEs. They were generating free cash flows, and they were less than 20 multiples. So logically, there is no need to be biased to say that यहाँ पे ही growth है और वहाँ growth नहीं है. There is growth everywhere. We need to have the right lens that how do we pick up the best business models at the right price in different markets. And the second point now is there are phases where in a calendar year or in a short cycle of 3 to 5 years, one market does better than another market. There will be phases when India will do well, US will massively underperform. There will be phases when Europe will do well, Japan will do well, and India will underperform. See, we all know about Nikkei 40 years of zero return, but in the last 5 years, Nikkei has generated similar or better returns than Nifty. So when you diversify appropriately, the relative volatility of the combined NAV smoothens out. And I have always believed that the biggest enemy of long-term compounding is volatility, because the more we encounter volatility, our ability to stay put gets challenged. We become anxious. And when we become anxious, we get out of the train. The train reaches its destination 10 years, 20 years from now, but we don't reach. So if you can get more or less similar returns over a 2-decade, 3-decade time horizon through a combination of a portfolio with lesser fluctuation, that is the objective of diversification. Now that diversification includes Indian stocks, global stocks, bonds, real estate, gold, combination of all these. And that's the core philosophy of why I personally look at investing some money of my portfolio outside.
Right, absolutely. So there were two things. One basically is with respect to the investor's behavior when you say the train is going to reach, but due to the volatility, the investor gets out and then he does not reaches the destination. And the second is that you said about the asset allocation. You need to have everything in your portfolio, and if you have the goals attached to it, then volatility come what may, but you are going to reach the station. So that is the takeaway. Now, I want to understand, now there are different kinds of funds that offer international exposure to the investors. So can you just tell us the types of these funds that offer you the international exposure?
I'll tell you my framework. Right? There will be hundreds of funds, and many times choice can confuse you. On the other hand, if you have a framework to choose, choice can empower you. If you have too many phones to choose and you want to buy a phone, you get confused. But if you have clarity that I am focused on quality, then this is the right phone. I'm focused on price, then this is the right phone. So what is my framework of investing? The way I look at it is that most of my income, or in fact, every rupee of my income is from India. My expenses are also largely today in India, but there are some parts of your expenses which are spent on global services or products. Which are the large profit pools of the world? Where are companies really, established? And actually, some of these companies are global companies. So, even their country of presence to some extent does not matter. But fundamentally, the large, pools of cash flows, revenues, profits are the big blocks are US. The second big block is China, for example. Then you have Japan. Then you have Europe, and we are a country, India. So these are the 5 blocks. And also, broadly, when you look at where is the profitability largely moving right now, it is technology. So first I gave you a geographical framework. Now, within that, if you want to take a thematic framework, then what are the big blocks of growth? Technology is a large block of growth. Innovation is a large block of growth. Then, companies in the consumer space, not just in India, but globally are again, very large blocks of steady return ratios, steady compounding, good balance sheets. So in this cycle, in the last decade, generally these type of companies have done very well. In the prior decade, when overall world growth was dominant, every country was investing in infrastructure. In that phase, the other side of the themes were popular. Energy companies, because demand for energy was huge. Demand for metals was large. Industrials, engineering companies, infrastructure, they were large blocks. So one approach is to just simply go out and buy, global index or an index of a specific country, like we buy the Nifty or the Nifty equal weight or the Nifty next here in India. That's one approach. The second approach is to say, I don't want to buy the whole market because my portfolio will become too wide then. I want to cherry pick specific stocks and themes. Either myself, if I have expertise. Most of us don't have that expertise because we are busy with our other life goals. Let me then identify fund managers who will pick up the best companies and the best sectors for me. So my approach today is part of my international portfolio is, whatever part I have is diversified to two blocks. One is the energy block, because last year when energy prices were at an all-time low, and through one of our funds which invest in global energy companies, so that is one block. Because I also at times like to buy what is less popular, and the other block is give money to four or five experienced managers who follow a very sensible style of investing. So that block is into a portfolio where the largest weight is Berkshire Hathaway. So in a way, Warren Buffett is the allocator of capital for you. And the second large part of that portfolio is a fund manager called Lindsay Train. Then there is Veritas. So there are different managers who are practitioners of good investing globally, and through them, and these are again through very simple funds on my platform, where I invest in that one fund, but that fund has access to these three, four different managers' rights. So, someone like a Lindsay Train portfolio weights are very large in UK, Europe, and Japan. Someone like Warren Buffett, largely, US centric. So, diversity that you get through the different styles and geography. So the approach, again, to your question is either it can be through geographical allocation or thematic allocation. And each investor then, depending on his time horizon, his level of understanding, whatever advice he gets from his advisor, should take a fund and invest.
Absolutely, absolutely. So, like we mentioned with respect to the geography, so India is the fifth largest economy. US, China are the top two, followed by Japan and Germany. So most of the schemes that we see in the international space are, more or less based to the exposure to the US companies. So my question is, why are the other countries not being tapped?
Because US itself is, a very large pool of profits, right? And at least in the recent decade, the best of companies have evolved from US. So again, the question to ask is, what are the products we like? We use Amazon, we use Apple, we use Netflix, we use Twitter, we use, Cisco, we use Visa, we use MasterCard. I don't remember we using products from Israel or, Germany or, even China is relatively not that well known in terms of the brands that we use. Of course, there are other brands like in consumers, there will be these, fashion brands. In confectionaries, there will be these European brands. In automobiles, there will be some from Japan, some from Germany, and some from US. But actually, the dominance of US companies in the world, at least in the last 10 years, has increased. And ultimately, capital will follow where there is success. So, which is why, and you have a choice. You can even today through LRS account, etc., through international funds, you can buy different countries also. So we have a fund called Global Asset Allocation Fund, which buys across the world. It's not US centric. 70% of the portfolio are basically stocks in different countries. US is one part of it, but other international geographies also, and some part of it is in fixed income because it's an asset allocation product. We have this value fund where 1/3 of the portfolio is again global, not American. So I think why more money has gone to US is because US markets have also done well, and companies there have innovated well. They have grown profitability faster than the rest of the world. So I think that's the primary reason. And these trends can change. Next decade could be China, could be Japan. Who knows? You have to keep watching and evolving, and accordingly aligning your portfolios.
Right. So there is one thing that sometimes investors do not understand, or it is quite confusing, is that when the investing is done into the international funds, okay, so basically the currency, the INR, is converted into USD or some other currency wherever the mutual fund is investing. So how are these risks with respect to the currency exchange rates being addressed by the mutual funds?
Yeah, so obviously when you do any international investing, you are taking a currency of that particular country. So when you're buying, investing in US stocks, you're converting rupee into INR, rupee into dollars. And then when you sell those stocks and get the money back, you're selling those dollars back into and getting it into rupees. Now, let's say if you do this over a 5 or 10 year period, the risk you run is currency risk. So if Indian rupee appreciates by 3 or 4%, then to that extent, returns will come down. Let's say your global equity exposure earns 10%, but the rupee appreciates by 3%. And when you get the money back, then you will earn 7%. On the other hand, global stock appreciates 10 and rupee depreciates 3, then you will earn 13 over the cycle. So far, at least the last 3 decades indicates that the trend for INR is to gradually depreciate over long periods of time. There are temporary phases when there is a sharp phase of appreciation, when our economic cycle is very robust, when our economy grows, we get a lot of capital inflows, whether FII or FDI, and the rupee appreciates. So when you are diversifying your portfolio between Indian companies and global companies, it in a way hedges itself. As a portfolio manager, we don't hedge the currency risk because the principle of global diversification also means you want to add some risk outside India. So it also means you want to take the risk of stocks outside, and you also want to take the risk of those currencies appreciating and giving you the advantage. It works sometimes, it does not work sometimes. At large, it has worked because the trend of rupee over long periods of time is around between 2 to 4% annualized depreciation. So to that extent, it adds back to your return.
Right. So just for our viewers, if the rupee depreciates, that is good for you if you invest in international funds. Okay, so INR will gain value, or USD will gain value, and that will add to your returns. And vice versa, if the USD depreciates and Indian rupee appreciates, it will be reduced from your returns. So that is one risk, that is currency risk. But overall, the trend has been on the positive side, where rupee has depreciated, and that depreciation has added to the returns. Now, so as we said, India is the fifth largest economy in the world, but it is still considered as emerging markets. There could be other countries too; those are emerging markets, and there could be other companies also that are not based in these five, six economies. Okay, so why are mutual funds not targeting? So, for example, I read somewhere that sugar sector in Brazil is absolutely great, where the yields are good and all those things. It is much better than India. So why are these small countries not being tapped? Is it because of the regulations, or is it because of the accounting standards or frameworks that are complicated and are not cannot be bridged with respect to that? Could you just throw some light on it?
I
Why are
think
these?
it's a function of priority, right? You also don't want to go to countries and companies which are less known, where they are too distant to understand. They are not mainstream, where regulatory stability is not well established. So these are things that you want to be very sure of when you are letting your money go away from you. So when you send your kids for studies outside, where will you send them? Will you send them to a Brazilian university, Russian university, or do you send them to well-established, well-known universities? It's as simple as that. That ultimately it's your hard-earned money that you're letting it go away from familiar zone, right? In the hope that it is going to come back safely and will come back with reasonable amount of appreciation. That is the simple objective. So ideally, you always would want to let your money be parked in established companies and established countries, which have demonstrated long history of respecting capital, letting money flow freely. Who knows, in some random country tomorrow capital flows are locked. So a lot of these things happen. Also, a lot of these smaller companies have reasonable amount of currency volatility because their balance sheets are not very strong. So it is also very important to ensure that you don't invest aggressively in a currency which is very volatile. नहीं तो क्या होगा कि equity में 15% बनेगा, but currency 10% निकाल लेगा. Your net return will be again very poor. That's one. Second, it is not true that international funds that many mutual funds offer, including DSP, do not invest in diverse countries. So, for example, we have a world gold mining fund where the largest exposure is to a company which is based in Canada. Then, like I said, in our value fund, the second largest exposure is a boutique fund called Veritas or Lindsay Train, where some of their largest exposures are again to a Canadian company and a UK company. We have our World Energy Fund, where 50% of that fund is invested in renewable energy and new energy companies and companies which are innovating technology to ensure that the green energy revolution can be captured over the next 2 decades. So it's a very, very long-term sustainable theme. And some of the largest company there is NLSPA, which comes from Italy. So we definitely have choices. Investors just need to study them, open the fact sheet, read them, and analyze them. But they are not very large parts of the overall capital pool, because the largest part of profit pool also is not coming from small countries. So you allocate money in proportion largely to the profitability and size of these markets. So if US is large, China is large, Germany is large, Europe is large, Japan is large, you will see those companies more in the portfolio and less of smaller companies.
Right. So
Just lastly, this last comment, if see, typically a lot of emerging markets also move, together. So if I have to take a play on emerging market, I anyways know that 99% of my money is in an emerging market, which is India. So I ideally want a more complementary pool of business models that India doesn't have. I don't want more and more of what India has. So in Brazil, for example, typically most often it is sugar companies. So then can I place some sugar companies from India, some metal companies? China could be, apart from their, Alibabas and digital companies, a lot of metal companies come from China. But then the lowest cost producer in the world comes from India, which itself is a global company today. So there are ways and means. So there is a lot of science which goes into construction of this. It's not as easy to randomly mix and match. So it needs a lot of in-depth analysis and study.
right. So now there are two kinds of, like we discussed. Now one of the offering that is offered in India is Indian plus international exposure in a single fund. So DSP has that in form of DSP Value Fund. And then there are these pure play international funds, so completely international focused funds. It could be passive, it could be active, right? So which one would be a better approach for an investor who cannot track the portfolio, or he has no time, he just wants the international exposure as well as the Indian exposure? So should he prefer the one that has both in a single fund, or should he pick two different funds?
So see, we have both choices. In fact, we were the first mutual fund to start giving international funds to India. DSP started this range of international products in 2007 and 8, when the cycle was all about emerging markets and it was all about India. So in a way, it was a very contrarian call very early, and it was a bit ahead of time. Today, the marketplace and customers are respecting the need for diversification. Now you have both the choices. So it's like, do I buy a mobile phone which has 5 other benefits, including a camera, a music system, and all of that, or do I buy a mobile phone which is just giving me one particular feature? Is a function of need. I personally have my exposure through both the routes. So when I want to invest in global energy companies, I use my thematic World Energy Fund. When I want to invest in only US companies, I have our US Flexible Equity Fund, which only buys, so it's a out and out global product. On the other hand, as we realize that there are many investors who say that instead of splitting across many global products, and global products have taxation of fixed income, we don't mind the product where you blend India and global together. So in one fund itself, we get combination of all. So that's where keeping the context of our market cycle, the context of relatively high valuations that we are all currently navigating through, we designed a new strategy which is more relevant in today's time, which is the value fund, where around 55 rupees is in good companies of India, but not the most expensive. Then around 8 to 10% is in cash, just to take care of volatility, which is there every 3-4 months. We see sharp corrections, so it can get utilized. And another 30-35% is in global value investors like Berkshire, Linsell, Veritas, Harding Loevner, and so on and so forth. And this has taxation of equity. So those investors who want equity taxation will come to this type of structure. Those investors who are okay with taxation of fixed income, there are some investors who say, I want to invest for the next 10-15 years. So I don't mind fixed income taxation because I also get benefit of indexation. Which you will not get here. So our job is to offer choices to our investors at different phases in the cycle. One or the other will make sense. I'm not biased by either, because ultimately both the pipelines are giving me what I don't have today as an investor. Let's say 5 years back, 100% of my portfolio was Indian. 4 years back, 96 was India, 4 was outside, and with time today, it has moved to probably around 88-12. Uh, uh, so you have different pipelines at different points in time. You take a call how you want to allocate.
Interesting. So that actually brings to me to my next question. That is, what is the percentage allocation, or is there a range that you would suggest to our viewers with respect to the international exposure? How much should be the percentage allocation that they should have?
So it's a very individual, very personal question, and there is no single answer I can give you because I can easily say 70-30 Karlo, but there is no science behind it, right? My personal exposure is right now 88-12. It could have been higher had I started earlier. If I was wiser early in life, I would have done a higher percentage. So some of these are things that you learn over time. And for example, today I am tempted to slowly increase my international exposure, not in a hurry, because I also strongly believe in the concept of mean reversion. So if for almost 10, 12 years, India has, massively underperformed, one of the reasons is, in India, amongst the top 5 sectors, 3 or 4 of them had large loss pools. So telecom sector had a very large loss pool. That's turning around now, right? With only 2 or 3 companies left. Metal sectors had a large loss pool between 2017, 18, 19. That's turning around now. Nowadays, you see everyone talking of metals, and the weight of metals in Indian stocks is very low today. Then oil and gas, energy sector had a very rough patch, so that created huge loss. Then banking went through a very long phase of NPA recognition and balance sheet repair. The first PSU bank balance sheets took a knock, then corporate banks took a knock. So profitability of corporate India has come only from 3 or 4 sectors like IT, consumer, selectively. Pharma went through a 4-year phase of slow profit growth. Profits tha, but slow tha. But a lot of big sectors gave losses. So which is why India has not done well. But banking has got repaired. In metals, companies are repairing balance sheets. They are taking advantage of price rises to not, leverage further. Telecom is, going through its repair because hopefully the consolidation will reduce price intensity. So as India returns back to profitability, there is a probability that India now does better than some of these, global markets. So though I know that dominantly we are all invested in India, but if I have to chase, I don't want to invest globally only because the last 2-year returns are very good. So because they have been on a 10-year high, I will gradually. So my approach is to do it through a monthly gradual addition through an SIP route. Even though today I can put a large chunk of lumpy money. So if I witness in the next 2-3 years very large shocks coming in global markets because of, let's say, suddenly central banks raise rates, or suddenly liquidity starts shrinking, and there is a large correction, I could use that as an opportunity to fast track my approach. Otherwise, let it build up gradually through SIPs. And the answer to this is an individual answer. I think each person should do his own homework, talk to his distributor advisor, and say that, okay, mera time horizon kya hai, mera risk appetite kya hai, will I be okay? See, the first question to ask is, will I be okay if for the next 10 years? So if I make the statement that how many of you will invest in international funds if for the next 10 years India will deliver superior returns to global stocks? A lot of people will say no. Be prepared that that can happen, and still be taking that call.
Absolutely, absolutely. That is very true. If we tell them, or if somebody tells them that India could actually outperform, then they would not place any bets on the international market, even though that might not be the right choice.
And
so yes,
predicting is still so. Even when I say that next 10 years India will do well, in my view, predictions mostly fail, or even if they work out of luck or randomness. So my whole thesis is the need to diversify is because you don't then need to predict. Once you are diversified, prediction ki zarurat nahi hai. So personally, my approach is identify broadly what's good, and usme what is underperforming right now, increase your weights there, and vice versa. So last point on this is typically when the Indian rupee is very strong, it has seen a year or 2 or 3 year phase of appreciation, is when I prefer to increase exposure to global stocks or global funds, because you are taking rupee out at a higher price. If rupee has depreciated for the last 3-4 years, then I will be slow, because I don't want to take rupees. I don't want to convert my rupee into international currency at the bottom of a depreciation cycle. So being a bit contrarian helps in these frameworks.
right. Interesting with respect to investing overseas when rupee is appreciating. That that again creates rupee cost averaging kind of stuff that will add to the returns. Now DSP Mutual Fund offers a wide range of products with respect to the international exposure. Could you just point us to couple of them, or three four of them that investors could look at?
I think to start with, because I recognize that investors, in India have just started this journey of understanding international investing, I would suggest basic blocks and simple products. So to start with, DSP US Flexible Equity Fund is the first choice. It's a simple product which invests in US companies. And one, slight differentiator there is this product typically is not tech overweight. A lot of international strategies globally or even in India have a very large amount of tech overweight because tech has done very well. This portfolio will have 18 to 20% of tech and not 30, 40, 50 because it's diversified. It has companies across sectors in US. It has banking, healthcare, industrials, beyond technology or consumers combination of all. So it's slightly and it's a very fundamental aspect that why are you going out? Because you want to diversify. Now, going out and then concentrating again in one or two sectors is a different approach. My bias would be to be diversified. So that's one simple product. The second product that I personally invest in is the value fund, where straight away in my 100 rupees, it gives me 30 rupees to global investing through some iconic money managers, like I gave you the names. So that's the second approach. Second product. Then we have a very interesting global asset allocation fund, which again buys international stocks and international fixed income. So in a way, when you buy global fixed income, no doubt you're getting low returns today because interest rates are very low. You hardly earn 1.5 to 2.5, 3% coupon. But those bonds would have still earned more than an INR bond because an INR bond gives you 6% minus 3% currency depreciation, versus there you get 2% with some amount of currency appreciation. So that's another product if you want to do a global asset allocation. So to start with, these are three, very simple products. Then we have, very interesting thematic ideas for investors who have the risk appetite and the level of understanding. So if you want to invest in, global energy companies, old and new energy both, then we have an energy fund. If you want to take advantage of, food inflation and rising food prices, we have a global nutrition and agri fund. Then if you want to, have a proxy to gold, my way of investing in gold is through our World Gold Mining Fund, where it basically buys stocks of gold mining companies. So it's a very volatile fund. I only advise that to be invested when the past 5-year returns are very poor, not very high. Because when gold prices come down, gold mining stocks actually come down at a higher rate than gold price. Then we have so these are some of the thematic funds which I would not immediately urge investors to look unless you have a deep understanding of these cycles. But to start with, otherwise, our US Flexible Fund, our Value Fund, our Global Asset Allocation Fund are very easy products for an investor to understand.
Excellent. So DSP Mutual Fund is offering all sorts of the international exposure products. I would suggest everybody to research them and contact your advisor or mutual fund distributor before taking an exposure. But all the categories that are required to diversify in international markets are available with DSP Mutual Fund. Now I come to the final question of this segment, which is totally off topic, and I ask this question to every fund manager: is that what would be one piece of advice that you would give investors in current market scenario?
Any advice has to be permanent, not cyclical or temporary. And the only advice I have is when you invest, be aware of what can go right and what can go wrong. Don't invest only, like I started by saying, don't look at only the rosy side of the coin. In investing, there are always three outcomes. In the short term, these outcomes can be price can rise, price can stagnate, or price can fall. In the long term, generally the outcome is prices rise, generally at large. Unless you are in Japan where for 40 years prices didn't rise. So in investing, don't be romantic about it. Paisa banega hi banega. There are always risks in investing also. So the first advice I have is that understand the risk of investing. Wherever you're investing, whichever product you're investing, ask that question that if my horizon is 5 years, what has been the worst case return in 5 years, any time in the history in this product? And what were the reasons for that? What was the environment for that? And is it likely that today a similar environment can happen? Then let me recalibrate my portfolio. So be aware of risk while investing. Number two, uh, uh, whenever that risk manifests, don't panic. Because if you don't need money on that day, that risk is, a risk on the screen. So like what happened in March 2020, 30-40% correction. But if let's say I need money 5 years later in March 2025, then the price or the NAV of March 2020 has no meaning. So not reacting to that is very important. And the third thing is most money is made because of the factor time. In the formula of compounding, time is raised with time is raised to the power of. Return is not raised to the power of.
Right.
And amount is also, principal is also not raised to the power of. Principal is in your and my control, how much we can save. Uh, Time is in our control, how much for how long we can save. R is mostly a function of market cycles and your time of entry. If you invest in an asset class at very high valuations, R will be low. If you invest at reasonable valuations, R will be also decent. So keep these three factors in mind. The highest impact comes from time. So ensure that you have enough time for your money to compound, which means stay invested for long periods of time. That's when real wealth creation happens. So I think these are the 3 points that I would like to share.
Amazing, amazing. So compounding works when you let it work, and if you have to let it work for a longer duration, that's all. So thank you so much, Kalpen sir, for doing this with us. We wish you all the best at DSP, and we wish you to become the largest AMC in India. Thank you so much.
Thanks, Rohit. If our investors become wealthiest, that is a very valuable goal to achieve. So thanks for inviting me and DSP, and all the best to all your listeners.
Thank you so much, sir.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.